Hello, so this is week 4, the balance sheet breakdown, and I'm going to run through some slides that I've prepared. Hopefully this will work. I haven't recorded from a presentation like this in a while. So look again at AMD this week. I looked at them last week and thought it would be good to do the continuation like you suggested. So the agenda for the talk is we're going to look at what does the balance sheet show, what type of assets are listed, how does the financial position look, what's going to stand out from all that, and what should we be paying attention to if we're managing a company like this or looking to invest in it. So I broke this down into a couple of slides here because it's a lot of information. So 2 slides for the assets and then 2 slides for the liabilities and owner equity. So all these numbers are in the millions. This is a pretty big company. So looking at total current assets of $19 billion, we've got a substantial amount of cash on hand at $3.7 billion. We've got some short-term investments, accounts receivable of over $6 billion. So that's money that they have yet to bring in. If we look at this ratio of cash on hand to accounts receivable, that's not bad. They've got more than half of those 2 figures together and looking pretty liquid. And then sitting on an inventory of another 5.7 billion, got a lot of product to be sold, and a lot of that is pretty easily converted to cash or to receivables, I would think. So yeah, there's a lot of money that they can be collecting on. As far as the other assets, these are longer term assets. I guess I forgot to change the top part where it says current. So we've got property and equipment of 1.2 billion. We've got a lot of operating lease assets, tons of goodwill. So I mean, I guess that's one of the things where you're looking at the art, right? That's a lot of art. To almost $25 billion of goodwill. The branding, the possibility of future contracts, just the marketplace positioning. Even though they are much smaller than NVIDIA, they have a pretty massive market share and are a huge competitor with Intel for personal computers as well as other types of chips. Acquisition related intangibles is, I believe, like the buying up of other companies and things that they've got going on. It's again a massive number, almost 19 billion. And then some other things, other assets that are not specified but are much smaller portions. So when we're looking at the liability side, it's looking pretty good. Accounts payable of 2 billion. When if we look back, we've got 3.7, I think it was, in cash on hand. So if things needed to be covered, they could be, as far as those accounts. The portion of longer term debt, though, I guess, okay, we have accrued liabilities. So I believe that would be the services that they've been paid for that they haven't provided yet. So that's probably like building out data centers, filling them with their GPUs and FPGAs and things, all the different types of chips that they do. They got to deliver on those goods. But if we think back, they've got that 7 billion in inventory, so there's probably a large allocation of that that's to offset that. So not that concerning, I don't think. Longer term debt, I mean, when compared to the assets, it's not that big. long-term operating lease liabilities, $500 million. It's a lot of money, but you know, it's not certainly not a bad position there. In deferred tax liabilities, you get $350 million there. Other long-term, almost $2 billion. So we're looking at total liabilities of $11.6 billion. Now looking at the equity, this part I'm a little shakier on because I haven't studied a whole lot about companies with public stock, publicly traded companies. It's a little more cut and dry when you're dealing with small business, and the equity is, held by the owners, be that 2 or 3 partners, or not a huge group of people. So you don't have a very complex situation with that ownership structure, and so the equity is much simpler to calculate. But there is a lot. So we're looking at $57 billion in equity. It's a lot of equity. Yeah, quite a bit of equity. And we'll talk about ratios here in a sec. So to me, it looks pretty good. Total assets of almost $70 billion. Total liabilities of only $11 billion. Total equity of $57 billion. And I did do the math to make sure that the assets are equal to the liabilities and the equity. It did match, so that was good. These are accurate figures as far as I can tell, but there's all that art still behind it. So financial position, like I was saying, it looks good. I looked at some of these ratios, calculated some of the stuff, and the debt to equity ratio of 0.2 is super conservative, especially for a company like this, that these guys are usually out there trying to leverage like crazy, buy up competitors, do R&D, all that kind of stuff, and there's very little debt to equity. The equity ratio itself of 83.2 shows really strong equity position, meaning that the company is internally financing itself by holding its equity, retaining those funds, and the debt ratio of 16.8 shows a low leveraging, so it's like a super low risk of insolvency. They've got all that cash on hand, and they've got liabilities, but they have assets to back it. They've got equity to back it. So what stands out? To me, the key takeaways are that $2 billion more in assets over the year before, but $300 million less in liabilities. So, I mean, that's $2 billion more in equity for the company. That shows a really frugal approach to the liability and to that debt ratio. So what stands out is, I mean, just how strong the financial position is. That low leveraging. I again think I should invest in this company. Yeah, that massive jump in retained earnings is super interesting. There's a lot they can do with that going forward. Probably some paying out to the investors, but also putting it back into these data centers and building out infrastructure. And that balancing of long-term liabilities, getting out from underneath the tax burdens. A couple slides back, when you were looking at the liabilities, it shows that they went from 1.2 billion in tax burden to 350 million. So they not only retained 2 billion more than the year before, but they got out from under $1 billion in taxes. So it's a huge jump in revenues. And so yeah, what would I pay attention to if I were actually investing in this company, which, like I said, I should. But if I was a manager at any level in this company, I would be paying attention to what was going right at this point, because it seems like a lot of things are going right. So take a note of what's working and trying to continue that, making sure that you're changing with the times and taking care of things. But yeah, I think that they're getting a lot right. So yeah, looking at the positive trends. What are the positive trends? How can you keep those going on? But then you also got to keep an eye out for future issues. So referring back to these on a quarterly basis, I'm sure, even a monthly basis, to see how are things trending along, and are there issues that are cropping up. And I would also dive further back in to see longer term trends. I'm sure that these are publicly available documents, and there's probably, Yahoo Finance charts. You can look at the trends of these things over the last 5 years, 10 years, 15 years, and kind of see how this is moving versus Nvidia and Intel, and maybe even other tech companies like Microsoft and Apple. So that's I think I hit all the points. Thanks for watching. There's a link to the source here. I'll include the deck as well as the video. So, all right, thanks. See you next week.